Hello, everyone, and thanks for joining me. Today, I'm having an exciting kind of video for you to share. There's a lot of aspects to it, a lot of kind of intriguing developments that have been taking place, and so this is something to consider as you think about Greenfire and everything that's been going on with the company. So, um, before I proceed to the details, I want to tell you exactly what you're going to be seeing today. So the first thing we're going to do is I'll provide you like a quick update to what the company is actually doing right now as we speak. So I have a software that I developed that extracts different parameters and able essentially to show us the exact status of the asset. You'll be able to understand the asset pretty well, I think, based on this presentation. Then we're going to be talking about in detail about the response from Greenfire in their news release to the Waterous Energy Fund acquisition, essentially, of the Greenfire shares, which is something that's been going on and been in the news lately. So Adam Waterous, obviously known as a brilliant banker, from Waterous Energy Fund, obviously huge ownership of over 90%. As far as I know, I think it's about 91% ownership of Strathcona, so ticker SCR, right? Strathcona Resources, and been really involved in various acquisitions like Pipestone, Serafina, stuff like that. Brilliant mind. At the same time, Greenfire had a really interesting communication about the deal that's been taking place and kind of the transaction. So you guys will enjoy kind of hearing about that, a little bit of an update, and gonna wrap things kind of like more in a story to really communicate about this company. I get a lot of questions about this company, and hopefully I do justice in explaining the situation and maybe learn a little bit myself. Now, the one thing I noticed is that um, in the past, in my other videos, I noticed like when kind of some of the feedback I get is that I'm very kind of maybe slow sometimes when I talk. So I post on YouTube, and you can always select the setting and run my speech a little bit faster, so adjust it to your own speed. So it's just you click kind of at the top right corner, and things just kind of move a little bit faster for you. So I'll provide you a quick update on what's going on right now as we speak on the asset. As you can see in the corporate snapshot, they basically Greenfire is essentially a thermal oil producer, right? And you can see the asset that's located in Alberta here. There's a demo smaller site that's located kind of on the north side of the lease. So this will be kind of that area right here, the demo site, and then you'll have basically the expansion site, which is here, which is where basically majority of the growth is right now. So the one thing to consider about what they communicate about their asset is that they're basically suggesting they're lower cost, growth oriented oil sands, so low cost of supply, and oil sand producer, as I mentioned, tier one assets in Western Canada. So that's kind of what they're promoting. Even though if we look at the SOR, we could kind of maybe see the SOR is a little bit higher, but there are other nuances that we're going to be talking about. So the key company structure details, you can see there's working interest of 19,000 barrels a day. They do have partners on this asset in Sinuk, as far as I understand, of 25% kind of ownership of that production. So there is a JV, so joint venture with Sinuk. And essentially, when we talk about the 2024 updated outlook, you can see that the working interest production is 20 to 21,000 barrels a day, and capital expenditure to produce those barrels is between 80 to 90 million dollars, right? So annually. So once you start looking kind of at the enterprise value, and we're going to be talking about that a little bit more about that structure, you can start kind of getting the story about whether the capital expenditure is appropriate. And as far as I can see, I don't see any issue with that. So the numbers of shared issues outstanding is 69.3, as you can see here, and market cap at close to $10 here is 687. So they essentially spending between 80 to 90 million dollars for a market cap of 687. And you can see here 12% senior secured notes, so essentially debt, right? at 239. So you can start kind of adding the numbers and getting kind of the idea of the credit facilities, but also kind of the enterprise value, right? So enterprise value, and now you basically see the working interest, which is 20 to 21, obviously with the working interest, the bottleneck in production capacity as they communicate here at 33,800, and starting to understand the picture of what this company is going for per flowing barrel, right? And then we can start kind of getting the idea of what Waterous Energy Fund actually paying for the acquisition of the shares. And we're going to be talking a little bit more about that and really see what kind of the issue is when it comes to that. So as far as kind of my personal update from the software that I developed, that extracts data from public domain and massages kind of the data and provides essentially kind of update that I can share with the community. So when it comes to their actual production data for the Greenfire asset, so we're looking at about 25,317 barrels a day. So 25,317 barrels per day, right there. So that's kind of what they produce right now, and that number, obviously, within the working interest production, you can see what they actually get out of that. And now you start seeing kind of the partitioning between their ownership and their JV partners, right? Another thing I will update you on is that this production, I've been asked, well, we're going to be talking a little bit more about the infill and refill wells. So what I allude to here is like infill wells and refill wells. And we're going to be talking about those as well. But when it comes to that, the question I was asked is, are those infill and refill wells actually work? And you're going to get a little bit more insight towards that. And I think it's kind of hard to answer because are those infills basically there to produce and sustain production, or are they there to increase production? And this is something that I've kind of been having a challenge with. But what I can tell you is that month over month, so the previous month, for example, in May, the production was 25,459 barrels per day, and in July, production was 25,317 barrels per day, which resulted in a decline of 0.5%, which is basically nothing. But in overall, production staying flat around at 25,500 barrels a day, right? With JV as they share, they get that portion of like about 2021. So this is something important to consider. So the overall number of the producing wells they have is about 43, right? So they have about, if you think about injector producer, so they have about, for the producer side, they have about 43, and sorry, my writing is horrible, I know, but they have about 43 basically producers that produced oil. And these producers, they have an average oil production of about 588 barrels per day. And this is something I calculated through my own software. The best well that on that lease in Greenfire produces about 1,572 barrels per day. So that's really good. And the numbers of the wells above the average of that I shared of 588 barrels per day is about 16, and below is about 27. So you can see there is a little bit of a partitioning there, right, between the high performing wells and the less, the not as good performing wells, which happens in every asset. So the top 16 wells on this asset out of the 43 wells produced about 74% of the overall production rate, and the top 5 wells produce about 29. So we know maybe there's some wells that are extremely productive, but there's a lot of wells that maybe not as productive, right? So they produce slightly below that 588 barrels per day. The injected steam rate on the asset was about 93,463 barrels per day, and they utilize 54 SAGD injectors for that. And the steam ratio for the asset is about 3.69. So when we talk about, let's say, the asset being top tier asset, I think it's really important to consider the SOR, but I do realize their geology is a little bit challenging there. So this is the number that I get, 3.69. And when it comes to infill integration, because they have so many basically injectors and a relatively smaller amount of producers, it's hard to calculate like how many of the infills they're basically integrating there. So this is something I monitor very closely. Now, I also monitor the water to steam ratio, which is an important metric. And their water to steam ratio, so steam that you inject basically to melt the bitumen that's going to be produced, and the water that they produce, that ratio is about 1.11, which is where ideally you want to have that water to steam ratio at about 1. So this is a really good number for them, which tells me that there's basically no issues with top water or bottom water or stuff like this. So this is looking pretty good. And the ratio of the water produced compared to the volume of total liquids, which is basically, we call it in our sector, we call it a water cut. It's about 80%, 80.44, which is a healthy number. And it's slightly elevated relatively to their peers, but this is a very typical water cut that you will see in SAGD asset. So the other thing that maybe I'll update you on is that I see a change in number of oil producing wells, slightly down. I get about -4, and I'm really trying to work now to see kind of if they're integrating more infills and if this number is going to be basically corrected, because maybe some wells went offline and some wells are being re-drilled and they're going to be coming online. And so this is not really indicative of anything negative. It's just part of kind of routine operation in SAGD. So in overall, long story short, the overall production on the asset is about 25,300. 25,400, and obviously they have plans to kind of continue growing this asset. And as we can see here, one can start kind of making conclusions based on market cap, the secured notes they have that due 2028, so not anytime soon. And then looking at the working interest, which is very important to consider, because now the asset ownership is not kind of fully their ownership, right? It's in a GV. So what actually happened, and this is kind of an update when it comes to everything kind of Waterous fund related, is that Greenfire Resources on September 18th, so they basically had a news release, right? And so the news release is associated with their kind of response to the Waterous kind of acquisition. And what they basically say is that given kind of the developments of what's been taking place, Greenfire believes that it's important for shareholders to be made aware of the board confidentiality engaged to these securities in July 2024 to assist the company with evaluating strategic alternatives. So basically what they're saying is that earlier this year, so in July, they engaged TD Securities to evaluate strategic alternatives given that the company discount valuation relative to pure play oil sands peers. So they basically felt that their value is not properly represented in the markets, and so they engaged in the strategic valuation. So when they did that, when they engaged with TD Securities, they determined that it was in company's best interest to update its reserve report, and soon we're going to be seeing exactly what kind of like reserves they have on the producing pads and an overall lease, and they really wanted to reflect the current development plans, which include utilize this latest SAGD technologies. So here they basically say, what are those technologies? So including its successful extending reach refill wells, and this is exactly what I will be talking about in this presentation, really showcasing like what those refills wells are. Then they also say that they're utilizing inflow control devices. So inflow control devices is basically you have two type of like FCDs, so flow control devices. You have outflow control devices, so OCDs, and you have inflow control devices, which is ICDs. So inflow is basically what's coming into the producer, outflow what's coming out of the injector. So you could have a flow control device that basically optimizes the flow of the liquids from the reservoir to the producing well. And what they're saying here is that those type of technology investments like refill, infills wells, inflow control devices are not really being captured in their stock price and the economic brownfield growth opportunities of the operations. And what they're basically saying is that they engaged the reserve evaluator to commence that the process, and the updated report is expected to complete it by year end. So, right, so they're working basically with a third party, and they believe that pursuing a strategic alternative, it's in the best interest of all Greenfire shareholders, and the completion of the proposed acquisition, they basically use the word would harm all other shareholders by prematurely and adversely affecting the successful conduct of the ongoing process and the potential completion of any shareholder value maximizing transaction that may result from this process. So they essentially saying is that this transaction and this price does not reflect the value of this company, and they want to basically kind of higher price for those shares that are being basically transacted. They go a little bit further and they put a statement related to Waterous Energy Fund, and they're basically saying that Greenfire understands that Water Energy Fund is a value investor in Calgary, which obviously he is, and is the Canada's largest oil and gas private equity manager, which he is, right? And according to the website, WEF, which is Water Energy Fund, pursues a value-based investment strategies. And I can tell you this is like 100% true, right? So if we look at Pipestone acquisition earlier this year, if we look at Serafina with all the assets they acquire, right? I mean, even when I look at like Meoda, Saskatchewan, right? When I'm looking at Edom, Strathcona, Edom, when I'm looking at just kind of from my list here that now, acquiring essentially Greenfire, right? Tucker Lake, Lindbergh, Orion. So when it comes to under Strathcona kind of umbrella, all of those assets, right? Many of those assets, they're very similar to Greenfire when it comes to kind of Greenfire Hanging Stone expansion demo assets. They're very similar when it comes to kind of oil production rate, and also, well, they're like in that range, right, of 20,000 barrels a day, maybe like 15 to 25,000 barrels per day. But also like the SOR is like steam to oil ratio, which is a good indicator of kind of economic value of the operations, is between like 3.2, I would say, to like 5 or something like that, right? Where assets like a Meg Energy would be like Christina Lake Meg Energy will be like, let's say, 102,000 barrels a day. Foster Creek Synovus will be like 190 to 200,000 barrels a day. A little bit higher now. The production is actually increasing. Christina Lake will be about 240, right? So this, it seems like the Waterous Energy Fund is kind of focusing on those little kind of smaller thermal players, and it's essentially a collection of all those assets. And in a way, like, I've been thinking about this, what's very common to those transactions, especially on the thermal side, is that the development, and I'm going to write it down maybe here just for the, for the listeners to kind of comprehend what I'm talking about, is that if you want to develop an asset, you'll pay something like $30,000 per flowing barrel, right? Per barrel to develop an asset. So, for example, if you want to produce an asset, a greenfield asset, 30,000 barrels per day in like 3 years, you will pay about $1 billion, at least $1 billion to get there. But in the process of you building this asset, it's going to take like year 1 or 2 or 3. If you were to acquire an operating asset, you will have essentially cash flow, right? So now you can get paid, you can cash flow, and you kind of organically merge into owning this asset. It's not different than basically acquiring a building, like when with the renters in the building that's starting to pay rent on day one, versus building or developing a new building, a new project, and basically not getting paid for like 3-4 years, and then after the time from taking basically on that risk of inflation and not cash flowing, but then kind of realizing the benefits in that final payment in a way, right? So if those assets are being developed at 30,000 barrels per flowing for those type of assets that we're talking about here, the historic acquisition that we've been seeing for those type of range, at least from a Serafina perspective, it was about, I would say, 55,000 per flowing to maybe 65,000 per flowing. And in that case, it was very close to 60, let's say 60. So the equation here is very clear. You develop for 30,000 per flowing, you sell for 60,000 per flowing on those assets. Obviously, this is not very applicable to an asset like Leismer, Athabasca, or Meg Energy, 100,000 barrel per day Christina Lake asset, because there's an element here of significant knob of like 30, 40, 50 years of net asset value of developing at the same rate, utilizing that steam, reallocating. So there's this additional value of the asset that could be maybe fairly traded right now at, let's say, 75,000 flowing, in my view, for some of those assets. Just a quick reminder that when Cenovus acquired 50% of, I think in 2017 it was, when Cenovus acquired 50%, and I think it was about 200,000 barrels per day when ConocoPhillips sold their 50% stake in the FCCL, right? So FCCL, they sold 200,000 barrels per day essentially. So with Foster Creek, Christina Lake, 50% stake, they sold for about $17 billion. And the price there was about 85 per flowing, 85,000 per flowing. And the market kind of really punished Cenovus going through like a downturn, and the stock price really suffered. So then they had to divest a lot of assets, like they had to divest Weyburn, for example, to Whitecap, and the Drumheller assets to Turkcen, and Suffield to IPCO. So there were a lot of basically consequences associated with that. So, but then if I continue kind of talking about what happened with Waterous Fund, we start seeing here that basically they say, okay, we understand that WEF, which is Waterous Energy Fund, right, is an experienced oil sands investor, which currently owns 91%. See, so they basically confirm that WEF, Waterous Energy Fund, owns 91% of Strathcona Resources. And Greenfire believes that the fact that WEF pursued a proposed acquisition at a 50% premium, the maximum allowable under the exemption, and without the benefit of any material non-public information provided by the company, is a testament to the high-quality nature of Greenfire's assets and the value inherited in its common shares, which is not reflected in the current trading price. That's what they're saying. And just a reminder that prior to that, in their statement, they said that the company believes that pursuing strategic alternatives, which they talked about, it's in the best interest of the shareholders, and that the proposed acquisition actually harming the shareholders. So this is the type of language they're using, which is kind of very, very interesting in this case to me personally. So what they're saying is that Greenfire assets and the value inherent in its common shares is not reflected in the current trading price, and the Waterous Energy Fund is seeking to acquire the shares at a price that represents a substantial discount to its pure play oil sands peers. That's kind of what they're saying. And the board believes that the proposed acquisition price does not reflect the intrinsic value of the common shares. So this is something that's very important to kind of keep in mind. They also can proceed a little bit further, and they tell us that they also know that it's the history of Waterous Energy Fund, and they said that the acquiring negative control of broadly held oil companies followed by full privatization within the next year, right? So that's basically they're saying that they understand the historic kind of record of WEF, and they said that in April 2017, Waterous Energy Fund acquired approximately 67% of the shares in Northern Blizzard Resources and purchased the remaining the outstanding shares in March 2018, which is kind of in support of their initial argument, and that in July 2020, Waterous Energy Fund purchased approximately 45% of the shares in Osum Oil Sands Corp, and subsequently initiated the unsolicited takeover bid and resulted in acquiring the balance sheet in April 2021. So they basically say, okay, we know kind of what's going on here. We understand the game, kind of like we're not really interested in that, and so this is kind of intriguing to me personally, but hopefully it kind of adds value to the listener to understand what they're currently going through and what kind of transaction it is, right? So let's talk a little bit more about and I'm gonna do a deeper dive into the asset. So you essentially, as I mentioned, you have two things here. You have the demo asset and the expansion asset. The demo asset is doesn't produce much anymore. It used to be kind of the core asset, but now it's all about the expansion asset. And you can see that 75% of Greenfire production is so the capacity of 35,000 barrels per day is basically from the expansion asset, which is 75% working interest, and the capacity for the demo asset is about 7,500 barrels per day, and it's 100% Greenfire owned, right? So you can tell that the third party basically came in to support the capex that was initiated through the expansion asset. And now we on this map we can start seeing kind of like where Greenfire Resources is located, and now you can start seeing all the members, right? So let's kind of see what neighborhood they're on. So you can see Mackay River basically right here, Sunrise, which is we'll talk in the future about Sunrise. I'm really interested in sharing what I think could happen to Sunrise in the future. And hint, hint, it's located between Mackay and Firebag. So okay, and now we have this telephone. They call it Telephone Creek. I think it's called more like Telephone Lake. So now it's a Telephone Lake asset that's not really developed. But the Hanging Stone expansion demo located very close to Athabasca's Hanging Stone asset. It's located to ConocoPhillips Surmont asset, which is a wonderful asset that I'm very familiar with. Mega Energy Christina Lake asset and Christina Lake Sonovus asset. And everything around Christina Lake, essentially like Jackfish, Sonovus Christina Lake, the Kirby's, Kirby South, Kirby North. We have kind of that Blackrod Greenfield expansion that's happening there from their pilot from IPCO. And obviously Coal Lake, Weapon Ranch, Sonovus Foster Creek there. And a little bit more to the south, we have I think Imperial Oil, basically Coal Lake CSS operations. So they basically tell us this is where we're located. Those are the operations, and now we learn about basically the ownership of the expansion asset and the demo asset. So here they say intermediate oil sands producer with a large, long life, relatively low decline oil sands resource, tier 1 SAGD reservoir, provides structurally lower capital and operating costs relative to most peers. This capital is 80 to 90 million dollars a year, which is not that high. And expansion asset is connected to the expandable pipeline infrastructure for diluted bitumen, right? So the bitumen is too viscous to flow by itself, so you have to dilute it, and the demo asset can be accessed via tracking. So this is something really to consider. The updated 2024 outlook focused on developing the company's exceeded capital efficient and productive inventory of refill wells. Let's talk about that right now. And deliver production growth of 13 to 19%, right? So this is what we talked about. Their production, current production is 25,000 barrels a day. And obviously they share that production with within their JV. Okay, do I want to go over the gross reserves, PDP, 1P? So I think here you kind of get the idea when it comes to their SAGD assets, kind of what's going on in the strategy implementation, and their independent reserves, which is PDP here, 1P and 2P reserves. And you can start seeing in million barrels, they have like 31 PDP, 1P 183, 2P probable, right, 238. And if you think about that 31 million, let's say PDP, right, you start kind of getting the idea that the current production rate, they could sustain that production for at least like, I don't know, 10, 20 years, right, or even further, without necessarily growing capex on the facilities, right? And on the NPV side, so they use NPV interest 10, you have essentially 746 million Canadian dollars in NPV 10, 2 billion in 1P, and 2.4 billion in 2P. And you have reserve live index of here they actually give it to us here 5 years, and I guess that 5 years I said 10 initially, but they maybe integrate kind of the infills and refills and assume that extra growth. So then they give us basically the PDP is 5-year, 1P is 28, and 2P is 37. So the reserve life index kind of, it makes more sense here. So that's been very useful. And here we can see working interest facility debottlenecking capacity, right? So 34, 20 to 21, which is the updated 2024 outlook, and 18 and 2023. So you can kind of see the working interest production growth in barrels per day. So updated forecast 20 to 21, annual growth 13 to 19, and capital expenditures 80 to 90. Okay, so I'm really interested. Okay, so they have like the WCS tightening sensitivity. Maybe we can go over this. So they basically tell us what peers they're using. The peers they're using is IPCO, Athabasca, Imperial, Gear Energy for some reason, Cardinal, Headwater, Rubellite, Surge, Tamarack, Obsidian, Strathcona, right? So Baytex, Megs, Cenovus, Canadian Natural, Varen, Crescent Point, previously Whitecup and Suncor. So they're all kind of here, and they said, okay, tightening sensitivity to oil-weighted producers. They're basically saying cash flow sensitivity is to US $3 per flowing. Tightening on WCS differentials, they have basically the highest sensitivity, so highest leverage to WCS movement. And the discount to relative peers, and then again, like your SOR is 3.6, is not like 2 or 2.4. And Leismer, there's like some significant gushers there that coming at well pairs, not infills, but they do have a point here where they say, look, we're trading at on 1,000 per flowing barrel. So that's the metric I really loved. So they're saying we're trading at 46,000 per flowing, right? So where I assume they allude to Meg and Athabasca here, those guys trade at 74 and 79,000 per flowing, which is, I think, like if Athabasca and Meg were trading at 46, they wouldn't even exist. Like these companies will get acquired immediately. And obviously, Waterous Energy Fund recognized the value in Greenfire, that they trade very cheaply, because as I mentioned before, the equation is fairly simple. You acquire at 30,000 per flowing and you sell at 60,000 per flowing. And on the higher assets, you obviously get to those prices, which are, they don't have a reserve life index of 5 on PDP, right? This number is much higher for those other assets like Lismer and Christina Lake and Meg. And so, but on relative basis, one could consider, okay, well, is 46 is too cheap, or is 79 too expensive? And I don't think it is, I don't think it is, but hey, it's all good, right? So we understand the slide. It makes sense. Okay, I really want to talk about the reservoirs. So what they say here is that the Tier 1 SAGD reservoirs have no top gas, no bottom water, or lean zone. So that's kind of how they quantify top tier reservoir. They say, look, when we have our pay, SAGD pay, right, we have nothing on top and nothing below that could really flow into our reservoirs, right? Soon we're going to be looking at their permeabilities, saturations, porosities, but they're basically saying we don't have bottom water, we don't have top gas. Now the disadvantage in having those, and I'll spend a little bit more time maybe covering that, is that that top water could flow. Let's say if you have injector, let's say, and sorry, producer and injector, and you grow in your steam chamber, let's say, if you don't maintain the bottom hole pressure within the chamber, so BHP, if you don't maintain the bottom hole pressure, that water is coming in and now competes with the oil that drains by gravity. Same goes for top gas. So let's say you have producer injector, you grow the steam chamber. Now, once you reach the top gas and you expand the chamber, the top gas can come into the reservoir, and now you have to sustain higher subcool to basically control the gas production. So what they're saying here is like, hey, look, we don't have to deal with any of this. So we don't have that issue that others have. Well, guess what? One of the best SAGD assets, so SAGD, steam assisted gravity energy, steam assisted gravity drainage assets in Alberta with SOR of about 2 has a lot of bottom water, and they're able to control it with bottom hole pressure injection. So yes, I understand the angle here for tier 1 asset, but maybe it's kind of you know, if you have SOR 3.6 and they have SOR 2 and they're able to control bottom water, then it's kind of up to interpretation. So what they say here is these steep zones provide an unwanted outlet for steam and reservoir pressure, right? So exactly what I was saying. Steep zones require costly downhole pumps and recurring pump replacement to achieve targeted production rates, leading to higher capital and operating costs. I understand that. At the same time, you can control a higher subcool and you don't have to replace your pumps every time. And same goes with bottom hole pressure. But pumps are an issue, right? Like you have to kind of every once in a while replace the pump and it's additional cost. But guess what? If your SOR is 2, you're able to do more with that steam. So you essentially, by definition, you are generating more oil production with less steam, and that allows the delta on basically SOR between 2 to 3.5 to do more with that steam while generating cash flow when you replace your pump. So I get that angle, but it's kind of give and take, right? So tier 1 SAGD wells flow surface with natural lift, right? So basically very high bottom hole pressure, and that fluid is draining by gravity and now able to come to surface without pumping and do not require downhole pumps. And management believes that the demo asset and expansion asset are 2 of 5 developed tier 1 SAGD assets in Alberta. So I literally specialize in that. I understand what they're saying here. Uh, I do think that the SOR metric is very important, so something to really consider. So, but hey, this is not necessarily bad. If you don't have to deal with pumps, it's really good. Here they do basically a study on the costs, on the savings, $30 million, $23 million on overall pump replacements, which they suggest that really benefits their asset. And it is, it's an additional cost. But if you're, let's say if you're Cenovus and you produce, let's say, your enterprise value right now for Cenovus, I don't know, it could be close to $50 billion, let's say, with debt. So maybe debt is like 4 billion and market cap, let's say 46. So in overall, you're at 50. And let's say your yield, your free cash flow yield, let's say is 10%. So you yield essentially, so free cash flow yield is 10%, which by just quick random calculation, you yield about $1 billion in free cash in quarterly, right? Maybe oil price is a little bit higher than here, right? Maybe 75, $80. Just speculating. We're not talking exact numbers, but we're speculating. Well, if we're talking about combined annual cost savings of $30 million on those 55 pumps or 47 pumps within like $1 billion free cash flow yield, right, for like a Suncor or Sonova, then I understand the benefit, but it's not like life-changing benefit in a way, right? But where you have like 1,000 million in free cash and additional kind of to the adjusted funds flow to the you subtract the capital which is 30, so you instead of like yielding $1 billion, you yield maybe like 970 million, right? So what is kind of the WTI or WCS price movement is there relative on like on that benefit? Is it like 50 cents or so? There is benefit, but I think it's important to be kind of mindful of that. So here again, we see the expansion asset and the smaller demo asset that was originally there. And here we can see in red, we have the gas pipeline here, and the diluent pipeline is in that color, like that yellow color right here, or orange color. The diluent bitumen pipelines are all in green right there. So we can see them right here. So this one and this one will be this one. The gas pipe will be this one, and the diluent pipe will be the orange one. So the orange one right there. So it makes sense. All right. So now we're thinking about kind of legacy operator, right? So Greenfire, um, I think they acquired this asset from Jacobs, right? So have many friends that used to work at Jacobs, probably have many friends in Greenfire. They're probably watching this right now and is like, what is Alex doing? Why is he talking about our asset? So hopefully I did some justice kind of to sharing some thoughts that make sense and not in representative of reality. But what they're basically saying is, look, we as Greenfire, we produce basically here, which is currently 25, and I confirmed that through my own software that they produce about 25.3 or zero point 0.4. We're going to see in a couple of days what they produced in August. So, and you can see historically they've been kind of in those rates with legacy producer, which is Jacobs. So 100% capacity is 35,000 barrels a day, 75% ownership with Greenfire, right? So 75% ownership, 35, and 75% working interest capacity is 26.3. So in overall, they will have to get to 35, kind of get what they produce now for their working interest in overall. So they drilled the first refill well and expansion asset in September 2023. Prior capital expenditures were primarily directed major maintenance optimization projects, right? So on facilities, stuff like that. So now they're saying we're focused on the refill wells. Soon will explain what this refill wells are, which will make sense. Essentially, it's kind of like what do we call it? Like a sidetrack well, right? Or a step out. So where you essentially redrill the producer, but you kind of go a little bit laterally towards kind of the non-developed pay, where the oil is still mobile from the heat transfer from the chambers. So they call it a refill well, but in the industry, we would call it like a step out or a sidetrack. For all other producers. So the company successfully drilled its first 10 extended reach refills, average monthly production rate of 1,500 barrels per day per well. So very good, right? And what I can tell you right now is if I'm looking at my software, their best producing well is 1,572.50 barrels per day. And I suspect this is probably one of their refill wells based on what they're saying here. So they also have multiple non-condensable NCG debottlenecking initiatives. So NCG, in my previous video, I talked about um, NCG co-injection for Hanging Stone asset. Please watch that video if you want to learn more about non-condensable gas. I did it mostly for students that I'll be teaching in January. They're going to take like a capstone course with me. And we're going to be talking about non-condensable gas co-injection. And essentially the goal with non-condensable gas is that you are able to reduce the steam-to-oil ratio, SOR, but by co-injecting a gas that doesn't condense at reservoir conditions and maintains the bottom hole pressure. So they're basically saying that they have an initiative in second half of 2023 resulting in sustained higher rates of NCG injection and continued increase in reservoir pressure, which is wonderful. So this is good for economics, it's good for the environment. It's a very positive. And look what they say here. Greenfire closed the acquisition of Jacobs in September 17, 2023, right? So 2023, legacy operator is Jacobs. So Japan, Canada Oil Sands. So obviously, a really good friend of mine was one of the reservoir engineers developers for this asset. So I'm very proud of his achievement. So that's great. Okay, so quarterly production is the startup, legacy operator Greenfire. So that's the demo asset, okay? So as we can see here, they have 100% working interest on the demo asset. So the demo asset is the little guy that we saw on the map here. So where is it? Where is it? Where is it? Yeah, so right there, this is the little guy, the demo guy. This is the expansion site, so the bigger one. So the little guy, they have 100% working interest in the not legal, no legal stuff here, but and you can see they produced about 8,000 barrels a day, right? So that's really good. And then decline of the asset. Legacy operator got most of the benefits between 2000 and 2016. Huge downturn, right? Huge downturn. 2016 Saudis opening the taps. Boom, production curtailment. You can see it just as I do, right? So when oil goes lower than cost of supply, the investor will say, well, shut in, don't produce it. You're losing money on producing that oil. Well, that's what was done. The problem is over this course of period of time, you're losing money. And look what luck they had. 2019, they're trying to ramp up production back. I still remember it was a very miserable experience for some of my friends. They're trying to bring production back here. And guess what happens? COVID, and boom, shut in back. And so I think the company is doing their best, around like the 2 to 3,000 barrels per day on the demo asset. But it's a challenge. Obviously, it's kind of a legacy asset. You can see the pad here. Let's kind of read what it says. Over nearly 2 decades, production declines at the demo asset have remained relatively low without drilling any infill or refill well. Guys, this is really important. This is when companies talk about low cost of supply, and we saw that example in Athabasca Hanging Stone, and they talk about that you don't really need to invest significant capex because the production decline is so small on relative basis to conventional peers. You can see here they've been producing some of this well since like 2000, right? So it's been like almost 25 years, and you still get production without putting any additional wells. So prior to 2024, most recent well pairs were drilled in 2013. So in 2013, the drill wells. How many conventional guys can say that? Not too many, right? Where you drill the wells in 2013 and you produce at like 3,000-4,000 barrels a day, and not like 20 barrels a day. So this is the real power about the thermal asset. Now, the other thing is that what happens in the steam chamber is that heat transfer, that when you develop the chamber, the temperature here on the sides, let's say it's 8 to 10 degrees, something like that. Within the chamber is over 200 degrees. But the steam chambers are so good in keeping that energy that even after like 5, 10, 15 years, you have very slow decay in the heat transfer to the pays. And obviously they said we don't have bottom water, we don't have top gas. So that energy is not transferred significantly to the pays around them, and it's able to basically kind of keep the energy within the system. And that's why you have this kind of residual heat transfer to produce more oil over time at very, very kind of low pace. So this, which is great. So under Greenfire's operatorship, production per well has increased in demo asset through NCG co-injection, right? So they're basically saying, look, we're allocating, we're maintaining kind of this asset, but we're not necessarily maintaining the entire pressure in the coalesced steam chambers with steam. We're also utilizing NCG co-injection. Greenfire drilled 3 extended rich refill wells in 2024, the first in history of demo asset. So we know they drilled a couple of refills, and this is a smart idea because when I was talking about, the steam chambers and the refill wells, so what essentially they're doing here, if I understand correctly, so let's say you have here you have injector producer, injector producer, injector producer, and you have the steam chambers like this. An infill you'll put here, you'll produce an infill here and here. Refill is kind of like this. So it's kind of like this, a refill well. Or they drill the producer and they kind of go in like this. So that's kind of my understanding. Maybe soon we will see a picture what they mean by refills, but that's kind of what I think about that. So they drilled the 3 refills, so that production may be going to increase, and they have every incentive because they have 100% working interest production in that in the demo project, right? So cost effectively accesses pipeline infrastructure for diluted bitumen and diluted via truck and expansion asset. So they give us a little bit more here pictures about the natural gas power dealing and transportation network. Man, so many slides, it's unbelievable. I'm probably going to have to do a little bit more of a kind of overview of the slides that I'm skipping here. Okay, so let's talk about comparison of SAGD incremental recovery wells. I really want to talk about this so then the viewer at least gets like a sense of what are those infill and refills they're talking about. So like I mentioned, I'm looking at the entire demo and expansion site assets. Both of them produce about 25,300 barrels per day, right? So Waterous Energy Fund acquires about 42 or so of the shares of Greenfire, but they have working interest of like something like 20,000 barrels per day, because third party, which is CNOOC, owns 25% of the asset, of the working interest in the expansion side, like I said, but at the demo, they own 100% ownership. What do they tell here? How do they define it exactly, right? So active producer right here, active injector right here, active producer, active injector, steam chamber development, steam chamber development. So this is going into kind of deep inside there. And infill producer. Here we go, infill producer. Now that heat has been transferred from the two chambers makes that oil here mobile. So now they don't have to drill an injector. Okay, what's a refill well? You have injector producer, steam chamber, injector producer, steam chamber. Now they say, okay, I'm abandoning the producer and I redrill it as a refill well. That's what they call. And you get the preheated bitumen, which is that pay between the chambers, because all of that heat transfer have been taking place. So let's read their definition. An infill producer is well drilled between two existing well pairs to produce incremental preheated bitumen between those well pairs. This is in my mind, and I've been talking to some people, at least this was my thesis for Athabasca for a long time now, is that this is an amazing strategy to kind of duplicate in a way the economics of heavy oil production, kind of like Martin Hills, so headwater production, where you just put in a well, an infill well, and you get the same economics, because basically you break even within like a couple of weeks, maybe if oil price is elevated. At worst case, maybe like a couple of months, because you cash flow in immediately and you don't need an injector. And those producers, they're not too expensive, right? And you're able to kind of work from the same surface area and go in and basically produce the oil that's already mobile. So it requires procuring additional wellhead, casing, as well as drilling and cementing new wellbore. So that makes sense. Additional civil work and tie-in to surface facility is necessary. But guess what? If you do a tie-in here, then the cost is not as high, right? So only if you do an infill, then you have the tie-in cost. Refill, they're probably going to say no tie-in cost. Tie-in to existing infrastructure limits incremental facility work, supply chain procurement efforts, and shortens execution timeline. Beautiful. That's exactly what I thought. If any of my students watching this, please think about this. We're going to be talking more about that in the future, because obviously for infill, you need that. You need an additional wellhead. For refill, you don't need that. So re-enter an existing producer to drill a refill producer well between SAGD well pairs to produce incremental preheated bitumen. Utilize the existing producer wellhead, casing, and infrastructure. Exactly what we talked about, guys. So, oh, look at this. This is like the extra extended reach refill, right? So steam chamber, steam chamber, steam chamber over length. You shut in this one and you produce the pay from here. 1600 meters, so 1.6 kilometers. That's the length of that well, which is incredible. They have lots of various refill wells that outperform infill wells, and they have some kind of distribution of company wells here. This is something I'm going to be really interested in talking about in the future. So let's kind of quickly capture that. They look at Greenfire. They look at Athabasca, CNQ, Cenovus, CNOOC, COP, MEG, Strathcona, and Suncor. MEG is really good in utilizing, and this is kind of what I'm seeing also in their infill integration. I can see that higher integration of infills in their operations, and there's smaller amount of kind of on relative basis of producers that are well pair producers in a sense, where like somebody like a CNQ still has a really good opportunity to increase that number of infills and refills. So maybe this is something for next time. Okay, so long story short, hopefully the listeners were able to better understand the infill refill integration strategy. Now, a common question I get these days, and really, it's challenging to answer that question, because I was asked this question, okay, Alex, just tell me are those refill infills work? Okay, just tell me. I just want to know. But previous month, I see production 25 point, let me talk exactly, 25.45 thousand barrels per day. And this month I see, okay, that doesn't make sense. Okay, yeah, like this, 9. So 25,459,000 barrels per day. And this month production is 25,317 barrels per day. So production declined slightly over the course since May to June to July period by 0.5%. Now this month, if they're able to kind of quickly bring those producers online and get additional 1,500 barrels per day, well, this number right away is going to increase to, let's say, 26,800 if those infill or refill wells do what they're supposed to be doing, especially if it's 1,600 meters length, right? So that makes a lot of sense. So we should be seeing those numbers coming, and there shouldn't be an issue. For now, we're seeing them basically drilling those wells. Now the question is, are the legacy wells that they have, those abandoned producers, or the active producers are declining over time, and then the infills basically sustaining those production, right? So you do have decline in the production wells, just like what we've seen before, like here, right? So it declines over time, and maybe the infills and refills that sustain the production. They're able to do what they do, but in overall asset, they sustain the production. That's going to be the key question, right? So hopefully, I learned a lot by sharing this data and sharing this information with you guys. This is really funny to me. I'm going to have to think a little bit more about that. But I have a suspicion that Waterous Energy Fund is really aware of that. And that's maybe why they made the move that they made. So because it's 30,000 per flowing, and you sell or kind of transact at 65, 60, 70,000 per flowing with Athabasca Meg, you kind of trade at those levels. So that makes a lot of sense. So these guys know exactly what they're doing. So we also talked about asset, where they're located. We tried to better understand basically the market cap, enterprise value, the debt structure. They do have some hedges here. So hedging policy, very important. So 12 months, 50% PDP, very important. People look into it, right? But they do have a lot of tax pools, which is very positive. So something to consider. But in overall, I hopefully I did some justice kind of sharing what Waterous Energy Fund is up to, what Greenfire response was, what Greenfire is all about, and in the future maybe talk more about the asset and go into kind of their strategy and development, technology integration, refill infills, and obviously maybe on monthly basis provide updates when it comes to their production and keep you guys in the loop about this company. So hopefully it makes a lot of sense and a little bit more about Greenfire Resources. All the best. Thank you.